Hey everyone, how's it going? So it's Monday after the close. Apple's up at an all-time high. I just want to kind of go over with you this earnings thing, just in a video format. I'll try and squeeze everything in. If I can't, then hopefully you get the gist of it. So why I was saying wait till Tuesday is because volatility goes up enormously. Like, here's a sloppy. This isn't what I use for for my volatility charting or anything, but this is just what this service has. You can go to iVolatility too for free, but it's a day delayed, so I can't really show you. It's not going to show you the latest info. But this purple line is the historic volatility, and then this blue one is the implied volatility. And so you notice how it's just ramping up, ramping up. That's how expensive options are. So options historically are only this price. Well, now they're this price because there's an event coming. There's a known event, so the stock will become very volatile. Options get super expensive. You want to sell those at the height of their expense. Now let's get rid of this little sloppy chart and come to a easier on the eyes. So see here, this is the mean volatility of here the top one. You have your weekly, August, September, etc. So this will keep going up, or it should tomorrow probably be up to 70%, 80%. It just depends on how much how much the options market's pricing and what type of a move. This See, when weeklies weren't around, you would have, so this would just be the August. This would be at 45 or so, then it would go to 40 and then kind of drop off pretty quick. Well, now these weeklies, they're so popular, they're soaking up so much of the volatility. Like, this will move to 70, 80%. And these sometimes kind of just don't move a ton more. So you should see 40, 45% tomorrow, but it wouldn't surprise me if these, because of their popularity, take up all the volatility. Regardless, these are gonna move up a little bit, or they're not gonna move down. Put it that way. So what's great is if you come, or let me go to just a short-term trader, like using hindsight, what you should have done or what a good play is. So you buy a call, you buy August call, we'll say, and you buy it right here for the run up. Well, not only do you get this run up, you bought this, the normal volatility is going to be about 20, 25%. So you not only get this big run up in price, you get another 10 points of volatility run up on top of your gains. So, and that's huge in the options world. So what you would do is you would buy here and then sell here. Don't even play earnings. Take this huge run up and the volatility gain and sell and be done. And you're great. You can maybe switch over to stock if you want to, do the gambling part of earnings or anything like that, for talking the straight up trader. So that's the ideal way to play it. Coming back to the long term trader, if you have, a cost basis from anywhere from, $20 and 10,000 shares, or you have 100 shares at $300, anything, it doesn't matter. Look how much you're getting out of this. So this is the August, and just coming all the way down here just because it's a dollar. This August 440 calls, you can sell against the shares you own for $1. So you can reduce your cost basis by one full dollar. That's huge. You do that over time. Like, say you just did it 4 times a year for earnings. That's $4 a year. You're lowering your cost basis, but you do that enough times and you're gonna be getting Apple at a deep discount, if not for free, depending on your cost basis. And then imagine doing that 12 times a year. So you have to, if you own stock, you have to be selling something. Now, odds are saying, if you come over here, remember that little delta thing I was showing you? It's not exact, but it's saying 7% odds that Apple's going to get to 440 in 3.8 weeks, 4 weeks we'll call it. If it gets up there, great, we'll deal with it when it gets there, because that'll be a good problem to have. But for right now, it's almost just free money. You're lowering your cost basis by $1. This is going to collapse on Wednesday anyways. So I'm just showing you the power of what volatility does and why you needed to wait till Tuesday before you made any moves. Do not do anything because this was probably last week. I don't even know. I know it wasn't a dollar though. I'll tell you that much. Um, so yeah, basically the ways to play it is if you own stock or leaps of some sort, you're a long-term investor, you need to come out here and sell wherever you think Apple's not going to be or whatever you want to cap your gains at. So if you're like, nope, I'm up at 500 camp, come and take $25, come and take 20 cents, 27 cents off your cost basis for free. It is free money. There's no risk with doing this. You have to do it. Um, and then the short term trader, if you're just neutral, bullish on Apple, don't know what to do, here's what you do: you buy a stock at 375. And this isn't forced in trade like he's saying to do it to do it. No. If you were gonna make a trade or thinking about it anyways, here's how you do it a lot safer. So Apple's 375. Let's say you buy it at. So tomorrow, your cost base is 375, and then you sell these 375 weekly calls. So you bought your stock for 375. You're getting it called away for 375. That's a 0% or that's a $0 gain, $0 loss. But guess what? You get to keep this $9.90 no matter what. So you're locking in a almost $10 gain no matter what. Apple can go to 500, you get a $10 gain. Apple can go to 0, you get a $10 gain. Um, I guess that's not the best example. This is a $10 below your cost basis. So if you really bought it at 375 and you got $10 of income, you really bought it at 365. So that would be your break even point. That's a better way to look at it. So, and if you want to, you can buy Apple at 375 and then sell this 370 for a little bit more protection. And you can do it that way. That'll only give you, a $7 gain total instead of a $10 gain. And then if you need to keep going deeper than that, you can go a little bit, as much as you want. You can keep going in this way. If you need to start going like real deep, you shouldn't be playing. It's just obviously you need too much protection. The reason I say don't buy puts or anything like that, just because of volatility is way too high. If you need puts that bad, pull your shares out, take a gain, don't play. Um, Another little trick you might hear is people saying the options market is looking to price, looking for a 10% move or anything like that. So how they're figuring that, if you hear on TV, so you take the at the money straddle. So you take we'll say the 375 is the at the money strike. So you take the at the money call plus at the money put. Okay, so you got $20 there, and then you take the at the money strangle, which is one out of the money, so $7 plus one out of the money on the put side, so $8, and then divide those by two, and you get $18 roughly. So Apple's looking for an $18 move, and that's how you know options are expensive, because if you went to buy this, like say you went to buy a straddle, one call and you bought a put because you were unsure of the direction, you need Apple to move $18 just for you to break even. So you don't even make a gain. So that's why it's buying options is overall priced for you not to win. And that kind of shows it there. Usually the options market it's priced for a reason. If you have this Thinkorswim platform, that whole formula I just told you, you can easily look it up. They just added this feature, I don't know, maybe a month ago or whatever. It's MMM for market maker move, and so they're looking for $18.37 move. But that's how it's calculated. So you can do it on anything. Yeah. So hopefully this answered a few things.